Right now, as you watch this video, there's money sitting in your bank account. You can see the number on your screen. You earned it. You saved it. It's yours. But here's something that might shake you. That money doesn't actually exist in the way you think it does. If everyone who has money in a bank tried to withdraw it tomorrow morning, the entire financial system would crumble before lunch. Not because of some conspiracy or criminal scheme, but because that's exactly how the system was built to work. This is the story of fractional reserve banking, the legal magic trick that's been running for centuries, and why understanding it might be the most important financial lesson you'll ever learn. By the end of this video, you'll see money, debt, and your own bank account in a completely different light. Let's rewind the clock to Renaissance Europe. Picture bustling market squares, merchant ships docking with exotic goods, and yes, actual treasure chests filled with gold coins. Back then, money was tangible. A gold coin had weight, shine, and undeniable value. If you were a wealthy merchant or nobleman, you probably had a chest of these precious metals somewhere. But here's the problem. Gold is heavy, and thieves are everywhere. Enter the goldsmith. These craftsmen didn't just shape jewelry. They had something everyone needed: secure vaults with thick walls and heavy locks. So people started doing something logical. They'd deposit their gold with the goldsmith for safekeeping and receive a handwritten receipt in return. This receipt was proof of ownership, a promise that said, "Bring this back, and I'll return your gold." Now here's where human behavior gets interesting. People soon realized something clever. Why go through the hassle of retrieving your gold, carrying it across town, and handing it to someone else when you could just give them the receipt instead? The paper became as good as gold because everyone trusted it represented something real in that vault. The goldsmiths noticed something else, something that would change the world forever. Out of 100 depositors, maybe only 3 or 4 would actually show up in a given week to claim their gold. The rest of it, just sitting there, gathering dust. And that's when the light bulb went off. What if the goldsmith issued receipts for gold that wasn't actually there? What if he wrote promises for 1,000 gold coins while only holding 500 in his vault? As long as everyone didn't come knocking at the same time, who would know the difference? The goldsmith could lend out these extra receipts and charge interest on them. He'd be earning money on gold he didn't even own. And just like that, money was being created out of nothing but confidence and paper. This wasn't a crime. It was innovation. And it was about to scale up into something far bigger. By the late 1600s, governments caught on to what goldsmiths had been doing, and they wanted in. Enter the Bank of England, founded in 1694. Now, here's the thing people often miss. The Bank of England wasn't created to help regular citizens. It was created to solve a very specific problem. King William III was hemorrhaging money fighting wars in Europe, and the royal coffers were nearly empty. So a group of wealthy financiers made him an offer. They'd lend the crown £1.2 million, an astronomical sum at the time, in exchange for a charter to operate as a bank. But here's the kicker. They didn't actually have £1.2 million lying around. They created it the same way the goldsmiths did, by issuing notes backed by a fraction of real reserves. The debt would be repaid over time through taxation. Your great-great-great-grandparents' labor paid for money that never truly existed in the first place. This set the template. Other nations followed. When the United States got its own banking system, the same pattern emerged. Banks issued their own notes, redeemable in gold or silver, but they printed far more notes than they had metal to back them up. It worked beautifully until it didn't. Every so often, rumors would spread. Maybe a bank made bad loans, or perhaps a prominent customer couldn't pay their debts. Panic would ripple through the community. Suddenly, everyone wanted their gold at once. Lines would form outside the bank doors. And when the vault ran dry, the bank would collapse, taking everyone's deposits with it. These were called bank runs, and they were terrifyingly common in the 1800s and early 1900s. You'd think the solution would be obvious: stop allowing banks to lend money they don't have. But that's not what happened. Instead, governments created central banks, institutions whose entire job was to act as the lender of last resort. If a bank ran out of money, the central bank would step in and provide emergency funds to keep the illusion alive. The message was clear: this system is too important to fail, so we'll protect it at all costs. Okay, let's bring this into the present, because fractional reserve banking has evolved into something even more abstract. Let's say you walk into your bank today and deposit $1,000 in cash. You check your app later, and there it is, $1,000 in your account. Feels safe, right? Now, here's what actually happens behind the scenes. Your bank isn't required to keep that full $1,000 in reserve. Historically, in many countries, they'd keep about 10%, so $100 would stay in the vault or in their account with the central bank, and $900 would get loaned out to someone else. Maybe it's a small business loan or a car loan. That borrower takes the $900 and spends it, and whoever receives that payment deposits it in their bank. That bank now has $900. They keep 10%, which is $90, and loan out the remaining $810. This cycle continues over and over, and by the time it's done, your original $1,000 has turned into nearly $10,000 circulating in the economy. But here's the twist. Only $1,000 of actual cash ever existed. The rest is just ledger entries, digital promises, debt waiting to be repaid. Now, here's where it gets even wilder. In many advanced economies, including the United States, reserve requirements were either reduced to nearly nothing or eliminated entirely in recent years. Since March of 2020, American banks have been required to hold exactly 0% of deposits in reserve. That's not a typo. Zero. So if there's no reserve requirement, what stops banks from creating infinite money? The answer is capital requirements and liquidity rules. Modern banks operate under something called the Basel Accords, a set of international regulations created by central bankers and financial regulators who meet in Basel, Switzerland. These rules weren't voted on by your elected representatives. They were crafted by technocrats at the Bank for International Settlements, sometimes called the Central Bank of Central Banks. Under Basel rules, banks must hold a certain amount of equity capital relative to the riskiness of their loans. Think of it as a safety cushion. If a bank wants to issue a risky $100 loan, they might need to hold $8 to $12 of their own money, shareholders' equity, to absorb potential losses. The riskier the loan, the more capital they need. Additionally, banks must keep enough liquid assets, things like cash or government bonds, to survive a short-term crisis. But here's the critical part. Banks no longer lend out deposits. That's the old mental model, and it's wrong. In the modern system, banks create loans first, which simultaneously create deposits. When you get approved for a mortgage, the bank doesn't go into a vault and count out bills. They simply update your account balance. New money appears because you signed a contract promising to pay it back. The loan creates the deposit. Then, after the fact, the bank checks whether they have enough capital to cover the regulatory requirements. This means that more than 90% of the money in circulation today isn't cash printed by the government. It's commercial bank money, created digitally when loans are issued. Your paycheck, your savings, the money you use to buy groceries, most of it exists only because someone, somewhere, took on debt. Once you understand how money is created, three realities become impossible to ignore. First, inflation is baked into the system. Because banks keep multiplying the same base of money into more and more credit, the value of each dollar slowly erodes. Yes, supply and demand affect prices, but there's another force at work. The currency itself is being diluted. More money chasing the same amount of goods means prices rise. It's not a bug. It's a feature. Your purchasing power declines over time by design, which means simply saving cash in a bank account is a losing strategy. Second, perpetual debt is unavoidable. Here's a paradox that should bother you. Money is created as debt, meaning someone borrowed it into existence. But that loan has interest attached. So if $1,000 is loaned into existence at 5% interest, the borrower now owes $1,050. But where does that extra 50 come from? It doesn't exist yet. It has to be borrowed into existence too. This creates a system where total debt always exceeds the total money supply. Someone, somewhere, must always default, refinance, or borrow more just to keep the gears turning. Third, wealth concentration accelerates. Banks collect interest on money they created out of thin air. Governments borrow from this system to fund spending without directly raising taxes. And the wealthy, those who own real assets like property, stocks, or businesses, benefit enormously. As newly created money flows into the economy, asset prices inflate. Meanwhile, wages, which adjust more slowly, lose purchasing power. If you're earning a paycheck and saving cash, you're on the losing side of this equation. If you own assets that rise with inflation, you're winning. Every few decades, the illusion cracks. and we get a painful reminder that this system is fragile. Let's talk about some of those moments. The Great Depression in 1929 is the classic example. Banks had been lending recklessly, fueling a stock market bubble. When the bubble burst, panic set in. Depositors rushed to withdraw their money. But the money wasn't there. It had been loaned out, multiplied through the fractional system, and when defaults started piling up, banks collapsed by the thousands. Millions of people lost their savings overnight. Not because they made bad decisions, but because the system was built on promises it couldn't keep. Fast forward to 2008. Same story, different flavor. Banks had multiplied credit through complex financial instruments like mortgage-backed securities. They created a housing bubble by lending to people who couldn't afford to repay. When defaults spread, the system seized up. Major banks teetered on the brink of collapse. And once again, governments stepped in, pumping trillions of dollars into the system to prevent total meltdown. They didn't fix the system. They just bailed out the trick. And it's not just history. In 2023, we saw Silicon Valley Bank collapse in a matter of days. Depositors got spooked, tried to withdraw, and discovered the bank didn't have the liquidity to cover the demand. The FDIC stepped in, and once again, the illusion was preserved. Here's the thing. These aren't isolated incidents. They're symptoms of a system that relies on confidence. As long as people believe their money is safe, the system works. But confidence is fragile. One rumor, one bad headline, one whiff of instability, and it can evaporate overnight. Now, let's zoom out because this isn't just an American phenomenon. In Europe, Canada, Australia, and the United Kingdom, reserve requirements have been reduced to nearly nothing or eliminated entirely. They all rely on Basel capital rules to regulate bank lending. Meanwhile, in emerging economies like China, India, Brazil, and Turkey, reserve requirements still exist and are often in the double digits. Central banks in these countries actively use reserve ratios as a tool to control how much banks can lend and to manage inflation. But even in those countries, Basel rules sit on top as an additional regulatory layer. No matter where you are in the world, the fundamental mechanism is the same. Money is created as debt, banks multiply credit beyond physical reserves, and the system depends on confidence to stay afloat. Here's the uncomfortable truth that ties it all together. The system cannot afford for you to be debt-free. If every household and business paid off all their loans tomorrow, the money supply would collapse. Banks would have no new loans to create deposits from. Economic activity would grind to a halt. The illusion only survives because you participate, because you borrow, spend, and believe the numbers on your screen represent something solid. You are both the fuel and the foundation. Your mortgage, your car loan, your credit card balance. These aren't just personal financial obligations. They're the lifeblood of the entire monetary system. So, what should you do with this information? First, understand that money is not the same as wealth. Money is a claim, a promise, a unit of measurement. Real wealth is tangible: property, skills, businesses, resources, knowledge. These things hold value even when paper promises fall apart. If you're stacking cash in a savings account and calling it wealth, you're playing the game by the wrong rules. Second, recognize that debt is not neutral. It's not just a tool. It's the very fabric of the monetary system, designed to benefit lenders, governments, and those who already own assets. Every time you take on debt, you're feeding the machine. That doesn't mean all debt is bad, but it does mean you need to be strategic. Use debt to acquire assets that appreciate or generate income, not to fund consumption that loses value. Third, accept that inflation is structural, not accidental. Prices will keep rising because the money supply keeps expanding. That means your strategy can't be to save harder. It has to be to invest smarter. Own things that grow in value as money loses its purchasing power. Real estate, stocks, businesses, commodities, skills that command higher income. Does this mean the whole system is about to collapse? Not necessarily. But it does mean the game is rigged in a specific direction, and your financial freedom depends on understanding the rules. Saving cash won't protect you. Trusting blindly won't free you. Building real, tangible wealth outside the cycle of debt and inflation is the only path forward. History doesn't repeat itself, but it sure does rhyme. The goldsmiths of Renaissance Europe, the bank panics of the 1800s, the Great Depression, the 2008 financial crisis, they're all echoes of the same story. A system that creates promises beyond what it can deliver, and a public that believes until belief becomes impossible. And here's the thing, this story isn't over. Every major financial crisis we've lived through has been a reminder that the system's stability doesn't rest on gold, productivity, or sound economics. It rests on confidence. And confidence is the easiest thing in the world to lose. The next crisis might look different. It might be triggered by a digital currency, a geopolitical shock, a wave of defaults, or something we haven't even imagined yet. But the underlying mechanics will be the same because the system hasn't fundamentally changed. It's still built on the same trick those goldsmiths figured out centuries ago. Create more promises than you can keep and hope no one calls your bluff all at once. So the next time you check your bank balance, remember what you're really looking at. It's not a pile of money sitting in a vault with your name on it. It's a number in a database, created when someone borrowed it into existence, backed by regulations written by unelected officials in Switzerland, and dependent on collective confidence to mean anything at all. This isn't about fear or paranoia. It's about clarity. Once you see the trick, you can't unsee it. And once you understand how the game is played, you can start playing by different rules. Rules that prioritize real assets over paper promises. Rules that build independence instead of dependence. The house always wins, but only if you keep playing their game. Understand the system, and you can begin to step outside it. Ignore it, and you remain just another player in a game rigged against you from the start. If this changed how you think about money, hit that subscribe button. History has the answers, and there's a lot more to uncover. Let's keep digging together.